also a tax strategist, and I've been in the finance industry for over 18 years. As a solopreneur, right, or someone who's an entrepreneur. Hello, y'all. Welcome to another edition of the Tax Takeover, where every week we do a deep dive into the tax code and we provide you with loopholes that can save you thousands, all right? So here in the Tax Takeover, we teach you how to tax plan like the wealthy, all right? So if you're joining me for the first time, let me introduce myself. My name is Samara Andrews, and I'm going to be your tax strategist for the duration of the show, okay? And so in case you're wondering, like, what makes her a tax strategist? Well, I'm glad you asked. I am an accountant by trade, a financial analyst by trade, but most importantly, I am an enrolled agent with the Internal Revenue Service. And as an enrolled agent, I specialize in working with growing and established business owners who want to retain more of their profits, pay themselves, and finally build a legacy through the tool of tax planning. So tonight's topic is the insolvency rule, right? And I know that this is probably a rule that you have not heard about because it really doesn't get a lot of play in the media, okay? But if you are someone who has ever received like a 1099 for a canceled debt, you probably didn't know that you could have used this rule to not report that income on your tax return. Okay, so if you received a 1099 for a canceled debt and you reported that income on your tax return, guess what? You probably overpaid in taxes, and I'm going to tell you why. Okay, so last week we talked about how you can exclude some or all of the profits from the sale of your home, and today is an exciting topic because the insolvency rule also allows you to exclude what should be taxable income, right? But if you meet certain qualifications, you can exclude that taxable income from your tax return, thus resulting in thousands of dollars in tax savings. Okay? So, the insolvency rule, right? This is a provision in the Internal Revenue Code, all right? So, Title 28, Section 3302 gives us the insolvency rule. And this was created back in 2012 is when this went into effect, all right? So if you remember what was going on around that time, right? A lot of Americans were in trouble because of the economy, right? So the economy has suffered a big hit back in 2008, 2009 range, and it just kind of continued, right? So a lot of people were in a lot of trouble, and a lot of people faced what we call short sales, right? And so to kind of help the people, this rule was put in place. At least that's my take on it because the timing seems a little right? So before I get into more that about who was able to use it, let's first understand the components of the rule. All right. So the rule is looking at assets and liabilities. So just to give you some background, assets are the things that you own. Like this can be your home, your car, a boat, etc. So these are physical items that add value to your worth. Okay. Now liabilities are the debt or the money that you owe. So examples of liabilities could be your car note or credit card bills, right? This is money that you owe to usually a bank or a financial institution because you maybe purchased something and you didn't have the money to pay for it all at once, right? Or upfront. So when people say my net worth is $1 million, what they're really saying is if you take all the things that I own, right, and you minus all of the debt that I have, then my net worth is $1 million. Y'all tracking with me so far? All right. So the insolvency rule occurs when your total liabilities exceed the fair market value of your total assets. So in simpler terms, it means that you owe more money than the value of what you own. Okay, so this can be due to various factors, right? Various factors such as you have a lot of debt that's mounting, maybe your mortgage payments, or even business related losses have contributed to you being insolvent. Okay, so now that we understand what insolvency means, let's talk about the benefits of the insolvency rule, right? So I want to point out three key benefits. One, Taking advantage of the insolvency rule could also mean that you avoid bankruptcy, right? So the insolvency could be a valuable alternative to bankruptcy. So by using the insolvency rule, you may be able to resolve your financial difficulties without the need for bankruptcy proceedings. Now, this can save you from lengthy and often complex process of filing bankruptcy, especially for my business owners, right? This can be an alternative to filing bankruptcy because if you're someone who is thinking maybe about growing your business, or maybe bringing on other investors, right? If you have a bankruptcy on your credit report, it's going to damage your credit report and it's not going to look good to investors. So, utilizing the insolvency rule can be a valuable alternative to just filing full on bankruptcy. Okay. The second benefit is that it can give you a fresh start. So, insolvency provides individuals with a fresh start, allowing them to discharge certain debts and move forward with a clean slate. Okay, so by excluding the canceled debts from their taxable income, you can alleviate a significant financial burden and focus on rebuilding your financial stability, right? So, it gives you that fresh start, right? And then, lastly, the reason why I really love this rule is because now, with the insolvency rule, you can exclude it from your taxable income. So, this is the most significant benefit of the insolvency rule, right? It's because it allows you to exclude that canceled debt or that forgiven debt from your taxable income, right? So, typically, when you have a debt that is forgiven or canceled, guess what? It's considered taxable income, right? And so typically you would owe taxes on that amount. However, if you meet the criteria for insolvency, you can exclude that canceled debt from your taxable income. And this can save you thousands of dollars in taxes, right? So, see why I get excited about this rule, right? So, now that you know the benefits, let's discuss the who qualifies for the rule, all right? So, to determine if you qualify for the rule, you're going to need to calculate your insolvency, right? So, again, what's the components that make it up, right? Assets and liabilities. So, this will involve you comparing the total amount of your liabilities, the debts, the things that you owe, against the fair market value of your assets, the physical things that you own that have value, all right? So if your liabilities exceed the value of your assets, then guess what? You may be considered insolvent, all right? Another thing to consider is that timing is important. It's important to note that the insolvency is determined at the time your debt was canceled or forgiven. So if you were insolvent before, if you weren't insolvent before and then you became insolvent after the debt cancellation, guess what? You still may qualify for the insolvency rule, right? So just know that you have to meet the criteria, meaning that you actually owe more than you own, and timing is a key component, right? And y'all, I know this works because I had a client whom I was able to use this rule in order for her not to report income as taxable income for a debt that was forgiven, right? This particular client had a loan that was forgiven for a vehicle, if I recall, and they sent her a 1099 for the income, saying that it was supposed to be taxable income. So I was able to dig into that tax code, found the insolvency rule, and then we were able to apply that to this particular taxpayer. Right now, please, please, please keep in mind that you want to make sure that you're consultant with an expert. All right. Because the insolvency rule can be a powerful tool for individuals facing financial difficulties. So, by meeting the criteria for the insolvency rule, right, you can exclude forgiven debts, right, that would otherwise be taxable, right? You can avoid bankruptcy and you can give yourself a fresh start. But you have to make sure you are linking with a professional to make sure that you are filing the proper paperwork, keeping the proper records in order to implement this rule successfully. All right. So it's essential, y'all. Consult with a tax professional or an accountant if you feel like you may be someone who can take advantage of the insolvency rule. All right. And so I want you to remember taxes can be complex, but with the right strategies and the knowledge, you can minimize your tax burden and achieve peace of mind, right? And that's the purpose behind the tax takeover, right? So thank y'all for joining me for another episode. If you like this content and you want to receive more, please make sure that you are liking, subscribing, and sharing our YouTube channel. Also, while you are there, make sure you turn on that notifications button so you never miss an opportunity to learn more about the tax tips that can save you thousands, much like the insolvency rule that we talked about today. And also, please don't forget to like and follow us on LinkedIn and Facebook, where we also share more information about our weekly tax talks, okay? And everybody's situation is unique. I understand that. So if you want to connect with me on a more personal level and you want us to create a tailored tax plan for you, then I advise you to also visit our website, www.fyefinance.com, and make sure that you book a tax consultation so that we can start creating that strategy for you. All right. So I know it's a lot of information. Hopefully you were all taking notes. I forgot to remind you how to do that at the beginning, but it's all good. So if you have any questions, please make sure you put in the comment section. I will also be, I'm sure, to reply to those, right? But again, thank you so much for joining us for another episode of the Tax Takeover, y'all. I want y'all to have a prosperous and wonderful Tuesday evening. And until next time, see ya.